This is the first Memlabs podcast, and if you really like this podcast, please let me know, and I'll potentially do more. To be honest, I was very stressed and way out of my comfort zone doing this. It's important to give me feedback so I know what you like and didn't like about it, and I can iterate on it. So about my guest, Annanay graduated from University of Cambridge reading mathematics and was about to embark on a PhD in quantum computing, but he ended up as a quant trader. He decided to quit his lucrative job to create QFEX, which has the potential to be a huge disruptor, and it will allow you to trade stocks in FX 24/7 without a broker and give direct market access. Annanay is a friend of the channel, and hopefully this podcast shows off the depth and breadth of his knowledge. I've also provided links on how to follow him and links to some of the Alex Gerko's excellent papers, as Annanay mentions him. Because this interview is quite long, I created a summary of key takeaways from Annanay at the end of the video, so if you don't want to listen to the whole interview, you can skip to the key takeaways. Anyway, I hope you find it useful, and don't forget to like, subscribe, and also give me your feedback in the comments. Okay, so Annanay, thank you for joining. This is the first podcast, so maybe just do a quick intro about yourself.
Yeah, thanks for having me. Hi, my name is Annanay. I'm founder and CEO of QFEX. I studied maths at Cambridge and then worked in high-frequency trading for 4 years. Around this time last year, I was on holiday with my friends in Cambodia, and I was basically complaining about how much money my last firm was making on some strategies that don't exist in crypto because of the way the market's designed and the way the market's designed better. And out of that came the idea for what I'm doing now, which is the first brokerless 24/7 exchange to trade traditional assets like US equities, commodities, and FX 24/7, round the clock, borderless, with high leverages. So yeah, that's what I'm doing now. It's been a fun ride so far.
And I think it's going to be very disruptive. But let's go, before we go into the QFX, but maybe just go into your background. Like you studied maths, and maybe just go over that and how what you learned and how those skills transferred to trading.
Yeah, absolutely. So it was like, I guess quant finance, quant firms, high frequency trading firms are really kind of well known now. Jane Street had that big scandal in India, and they've kind of come out of the woodwork a little bit. When I was interviewing for jobs, almost no one knew about them. There was like no press about any of these firms, even though they were already making like a decent amount of money at that time. Even at Cambridge, I think very, very few people outside of the maths community would have heard of these firms. I remember thinking it wasn't a completely trivial decision whether to take the trading off from Goldman or go to the first one that I went to, Flow Traders. So obviously I studied maths. Nothing that at the time felt super relevant to trading. I mostly studied theoretical physics. But it turns out a lot of theoretical physicists end up in trading for reasons we can, I'm sure, get into later on the podcast.
Yeah. Noisy data.
Exactly. And basically at Flow, I joined the FX desk very briefly and then worked on the crypto desk, making strategies to trade altcoins for the first time. So really cut my teeth there. Flow is like a great firm with a great trading program, really, really good trading program. And you get a lot of responsibility very early. So, I was running risk from like very early, kind of 4 months into the job, taking kind of trading decisions, risk-taking decisions. And towards the end of my time there, it was kind of end of 2021. Crypto market was really inefficient, really easy to make money in. We were making lots of money at the firm. We didn't have any restrictions on personal trading. So some of those strategies I was running on other exchanges on my personal book and making a lot of money there. So I decided to leave and then ended up at, I tried to run those strategies to be honest, but around 2022 things got noticeably more competitive in crypto.
And those edges that you had, they were speed or statistical?
So the edges I had at Flow, they were kind of, I don't even know they were edge. We were just there in the market, right? Like the market was so inefficient. If you had a pulse, you could make money at that time, to be honest. So there was certainly no statistical edges. I guess we did have like a decent latency stack, and we had, on the crypto side, you want to optimize more for network latencies. Exchanges were very slow, and the variance and how quickly they would process orders varied quite a lot. So it was very interesting for Flow that they could kind of come in and look at the problem again from scratch and figure out a lot of improvements that frankly wouldn't make any difference in traditional markets, but made all the difference in crypto markets. They were hosted on cloud exchanges. You have to send data over the internet rather than over these like hardwired lines and so on. So it was a real equalizer for a lot of trading firms. A lot of good trading firms didn't manage to monetize that flow very well, and a lot of However, a lot of small shops did very, very well. I had like friends who, a bit older than me, left and made their own kind of crypto trading firms in early 2021, and they've retired off the money, frankly. So
like the kimchi trade type of like opportunities.
The kimchi, yeah, the kimchi trade was like a regulatory arbitrage, I think. More just like simple market making strategies, picking up flow on exchanges that bigger firms didn't have time to connect to. You got to remember how fragmented the crypto market was and still is, right? Like on traditional futures, generally for like every instrument that you want to trade, there's like one exchange that covers it, right? So if you want to trade S&P, you go to CME, they trade S&P mini futures there. You want to trade a FTSE, you go to the UK. You want to trade Euro stocks, which is like a basket of the top European companies. You go to Eurex in Germany, Frankfurt. In crypto, you want to trade Bitcoin. Bob your uncle. Like there's so many choices. You can pick so many different places, and all those places need liquidity providers. And there's not enough market making. There's not enough trading firms to handle all those places, especially the ones that are a bit wary about compliance. So I think that's where a lot of the opportunity was.
Like decentralized, like exchanges.
Yeah, I mean, at that time it was more centralized, and now decentralized exchanges, yes. A lot of major firms just won't trade on decentralized exchanges because like their compliance won't let them. They don't KYC people. They don't want to be in the flow of laundering money. And as a result, a lot of smaller firms have made their founders rich and rich beyond their wildest dreams because they're uncompetitive. I think that may change at some point in the near future. I think DEXs will come more into the kind of the regulatory sphere. But yeah, I mean, at the time, look, when I left Flow, we didn't have much edges other than we just knew where the opportunities were and we were there, and they weren't necessarily where you think they were. We were doing trades like, I was literally with the Coinbase guys yesterday. I was telling them we used to do trades where we used to arb between Binance and Coinbase, and what would happen was Coinbase would keep some coin that people had deposited to trade with on their exchange at spot, right, on their wallet. But in crypto, you have like a cold wallet and a hot wallet solution.
Yeah.
So the exchange would never keep all of the currency in the hot wallet, which is the one that people kind of deposit and withdraw from, because if it gets hacked, they lose all the money.
Yeah.
And basically, if there was a big withdrawal on like a smaller coin, let's say an altcoin, then what would happen is that this hot wallet would get depleted. It would take the exchange a long time to top it back up. And we were able to monetize that because if anyone did a big withdrawal, we knew that the exchange would block withdrawals. And then the value of the coin in that exchange would plummet, because even if you bought the coin in the exchange, you don't know when you're going to be able to get it out. And sometimes it would take them days to replenish the coin. And our edge was we would just watch Etherscan or whatever scan to see the balance in the exchange's hot wallet. And if they topped it back up again, we knew withdrawals were about to be enabled on the API imminently. And it would still be trading at a discount versus the other exchange, let's say Binance, right?
Yeah.
So we would just buy it on Coinbase as much as we could up to the Binance price. And then as soon as they enabled withdrawals, we would move it to Binance and sell it there. Gotcha. So, these kinds of strategies, we just knew where to look. I knew guys who were making money because, we used to do this. We used to watch when Binance listed a coin, and generally on any other exchange it was trading on, it would pump. And first we found out that Binance announced it on their website, and you could just scrape their website and then pump it. And that did okay. And then we found out someone's beating us to the game, and it turns out they announced it first on Twitter, right? And then even Twitter was too late, and then we couldn't figure out where they were doing it from. And I asked some other guy, and he said, they changed one of the API status enums to like pending even before Twitter.
So they're looking at the actual code.
The actual API, yeah, exactly. So the reference data, if you just get a list of all the symbols, before the pair would get listed, it would get added to the API. So market makers basically would have the API reference data.
So they'll be just polling that API.
They'll be polling it, yeah.
Yeah. That's interesting.
Makes me feel silly. Like, why don't we do that? Sounds easy enough. So, I mean, that was really, what I left the market 2021, and I thought this would continue forever, and it didn't. 2022, things got very, let's say, competitive. I started looking for other jobs. I got a number of offers. Winter Mussolini, they all offered me well-known crypto trading firms. I joined Tower Research, well-known market-making firm, well-known high-frequency trading firm, part of which was market-making. I joined a team there that was very successful doing crypto. I added orthogonal strategies in the altcoins compared to what they were doing, which is mostly kind of major coins. That went fairly well until Tau got into a lawsuit, which is very public, around SEC action about them trading crypto from the US, which was illegal at the time.
Oh.
So we turned off crypto, and I started trading Chinese commodities. And yeah, it was very different, I would say, very different market structure, and lots of different things I didn't have to think about before. And that's where the seeds of QFEX really formed, as I saw that there's big difference in these two market structures. Why is it that crypto exchanges are able to offer so much more leverage, so much more UX? Like, are they just more reckless? Are they doing something better? And the answer is a bit of both. The way they're structured and the way they do risk, and the way they do liquidations is better. It's more capital efficient, and they have more control over risk. But they also offer too much leverage. So as a result, they have this bad reputation, which we want to avoid. The more I looked into it, the more I thought, there's no way that there isn't going to be an exchange like this in the future. And I don't know anyone else building something like this, so we just got to go out and do it. And a lot of other things fell into place. One of my best friends from Cambridge, he just quit his job at Citadel.
Josh.
Josh. So I knew he would be a very good co-founder, and we got funded very, very early. Yeah. So we've been on this roller coaster ever since.
Nice. And you got into YC. Maybe just explain what YC is and how that process went and what you learned from that.
Yeah, so YC is basically a venture firm that calls itself a startup accelerator. What that means is they invest money in you very early stages. They're a pre-seed investor. They're the first money that goes into a new company.
Yeah.
And in return, they have some value to add to you. So the value YC adds is fairly well known, because YC is a very good brand, very well regarded. So you get instant credibility. They have very active socials. They'll post about you, and you get to go to San Francisco for 3 to 4 months, and they're willing to stay forever, but for us it didn't make sense to stay forever because we're doing a finance company. You got to go there, you get partners assigned to you, they're very responsive, they give you advice all the time. And it's really those early days when you don't really know what you're doing, you've never started a company before, you don't know how to deal with lawyers, you're doing so many things that are out of your comfort zone, not your skill set. And you get access to this wiki of all of the combined wisdoms of all the previous YC founders. And you get your partner's personal phone number. And those fledgling stages are really important. I think that they do give you a lot of help, a lot of information. It was just a good way to experience the Silicon Valley culture. I mean, there's a reason it's kind of the economic capital of the world. All the kind of companies that are successful in the world, you kind of think about them, they're all basically Silicon Valley startups, right?
Yeah.
I think there's nothing quite like moving there and breathing in the culture. That's something we've tried to take with us wherever we go.
And the guy who created Monzo Bank, he's one of the partners, is right? Tom is his name?
Yeah, Tom Blomfield. He was actually one of our partners as well.
Nice.
We had 3 partners assigned to us.
Very valuable.
Phenomenally helpful, actually. He just became an AI ambassador, appointed by the UK government. Today, I just posted about that. Tom was phenomenally helpful. All aspects. I think he kind of got the idea very quickly and knew exactly what we were trying to build. Obviously, having been through the fintech building, and all the things that are involved, regulation, it's a little bit different to a lot of SaaS businesses where, even if something breaks, you can kind of just taper over it and keep plodding along. We really want to do things right and have everything stable. He was very, very helpful. And Tom himself is not only a partner at YC, but also went through YC early on, when he was my age.
I didn't know that.
Yeah, exactly.
So he's like a
So he actually found Go Cardless, which is big in the UK, right? It's a direct debits company.
Yeah.
Which was a YC company, and then he left that, and he then founded Monzo, which also received money from YC.
So he did YC again, even though he probably didn't need to go through it again.
Yeah, indeed. I think he didn't do the actual batch again. He didn't go through the early stage again.
Yeah.
I think one of the later stages of his company, after he'd already started it, was funded by YC.
Okay, right. So maybe we go let's go into more the quant trading advice, and then we'll go more into QFX. So let's say you're on a desert island, okay? Let's say how you got there doesn't matter, but you've just got a laptop and you've got like maybe just a decent GPU, not too good, not too shabby.
GPU is already pretty good. I mean, it's better than what we were running on.
Yeah, yeah. So just say you haven't got any supercomputers. You haven't got and the only way you can get off this island is you have to trade, and you've got internet connections, so you can download data. Maybe you don't have that speed advantage. Being on an island.
Yeah.
Like, what would you do? Like, what data would you download? What would you trade?
Yeah, how fast do I need the money?
You can use QFEX as well if you want to.
Yeah, okay. How fast do I need the money? How quickly do I need to?
How quickly? Okay, that's interesting. You can make it very well. You might enjoy it on the island. You may want stable.
Yeah, exactly. You got to think about these things. I'm thinking about it from a trader, right? I'm like, okay, if I need to get out immediately, I would obviously just gamble it immediately. If I have a few weeks, I would do something a bit more systematic.
Okay,
especially when I need to make a lot of money.
Let's constrain it. Let's say, okay, like 6 months, like then, yeah.
6 months, I need to make a lot of money, and I can't afford to lose a lot of money.
Yeah, yeah.
Okay, this is when this is when I would start doing HFT. So those are all the constraints we need. So you have a bit of time to set things up. You can't like lose all your money. So you want high Sharpe, good risk-adjusted returns. You want to make good money. 6 months, yeah, you can make good money. Like typical HFT strats. Not typical, but like a good HFT strat, you could even make like 50-100% return on capital in 6 months.
Yeah. What data would you download? Pricing, order book, trade feed, or do you?
Yeah, I think what I'd probably try and do is connect to a less competitive crypto venue, which has, again, depends how much money I need to make and how much money I have to start with. But I would broadly, I would connect to a less competitive crypto venue and try and market make on there using data from Binance or whatever the most liquid exchange is that lists the coins that are on there. And how I would go about it, I would first go through the entire Binance spec for futures and the entire spec on the other exchange, read the API, understand the order types, understand everything very deeply, look at the market data and trading endpoints, and do analysis of speed on them. So spin up clusters and try and figure out where the fastest endpoints and connections are, because market making speed is really important, and there's systematic ways that you can kind of analyze.
But all the exchanges all on the cloud, right?
Yeah.
So you would maybe just spawn up in the right data center, like in the same.
Yeah. So that's basically the first thing. So you have AWS. Most of these are in AWS, and therefore you want to set up your servers in AWS as well. Basically. So you would try and spin up machines in different AWS servers and then figure out which ones are closest to the exchange servers, right? Yeah. Using standard techniques, ping the servers, ping the testnet endpoint, and so on. You would then, put your machines in those servers, they're co-located, so as fast as possible. And then the exchange also has multiple feeds, multiple different ways of distributing market data. And you just consume them and see which ones are fast. Try and optimize that part, but not over-optimize. You don't want to spend months and months on it. You may want to spend a few days, get a cursory glance, and kind of do everything. Once you have kind of market data and trading established, I would then, write the code to run a market-making strategy, which I know in the back of my head, inside out, basically. And then, I would capitalize the strategy, start trading small sizes, do some post-trade analysis, and then wherever the strategy looks good, just scale it up and then hope for the best.
Yeah, hopefully get off there. You'll get off there, wouldn't you? Yeah. Okay, so all right, that's interesting. Okay, maybe just like advice as well, because a lot of viewers are like they want to get into quantitative trading, and also maybe they've just joined a firm as well. So like, what advice would you have for people that are like wanting to get into, like, what ideal background you think is good for quant trading?
Yeah, I mean, if you want to be a trader or a quant, you definitely want to study maths or maybe physics at kind of a top university. So a lot of the stuff is like very research driven, right? Like I would say, a lot of these firms that research the names, people call themselves quant researchers and so on. You are constantly trying to discover new ideas and then implement them to make money off them, right? So that is basically the name of the game with trading, is like it is a very competitive beast by nature. You can learn the basic principles of how markets work, but then it's up to you to go and like monetize and figure out how to make money, right? And traders who stand still and just kind of do the same thing over and over, like they get arbed out like pretty quickly. Often, months, if not kind of a maximum of a year, that you'd be able to kind of run a good strategy before it would just start losing money. So you always need to constantly improve things, and for that reason, trading firms bias mostly on kind of what they perceive to be your intelligence, your ability to learn and adapt quickly, pick up unfamiliar concepts, and that's why they just kind of tend to go for like high IQ rather than kind of necessarily deep understanding of economics, trading, all that stuff. I think like having previous experience with trading is not really relevant at all. It can show a bit of interest, sure, but you still have to kind of convince them that you have that mindset. I would say there are two types of trading firms. So there are kind of the Chicago-styled firms, which most of you came from old pit trading firms, and they have a decidedly different culture and often a different way of thinking about the markets than the more New York-based kind of ex-MIT crowd firms. And I've worked in both, right? So I worked at Flow Traders, which was spin out of Optiva. Optiva is Dutch, but their biggest office is in Chicago, and they definitely have that kind of trader culture. Susquehanna, Jane Street, is a spin-off of Susquehanna, is definitely that kind of more Chicago-style firm. IMC is also that kind of a firm. So basically firms where people think more about the markets as a game in a game theoretic way rather than necessarily just trying to make statistical models all day and all night. And they maybe they rely on some models, but they also add their own discretion as an edge. And the other kinds of firms where they just view the markets as a pure scientific research statistical problem. They're there to predict the market. Everything is fully back tested, fully automated. They would never use human discretion and so on. So for the former type of firm, playing competitive games, especially involving money, or even not, like chess, poker, these kinds of things, show that kind of mindset, that kind of competitive game theoretic mindset, which is very hard to teach, and basically some people are just kind of innately good at. And then for the other kinds of firms, we're talking about like Hudson River Trading, Jump Trading, Tower Research Capital. These kinds of firms, maybe that stuff isn't as important, I think. Gotcha. They just want to see really high quality academics. A lot of the people they hire there,
Yeah. What would you say, like, for example, like the Tower Research and Flow, like, what's the key characteristics of like the top quants or traders there? Like, what would you say are some of the key characteristics they all shared?
Yeah, I think, look, they're very, very commercial and very pragmatic, right? Like the key people who do well in this industry want to make money, and that's the most important thing to them. So I'm not saying they want to be rich. That's the difference. I think so a lot of them, you look at Alex Gerko, think how rich he is. It's a crusade for him, right? Like he's posting on Twitter every day. He cares deeply about markets, and he wants to make money because it proves him right. He's like, I've done something right, and this is why my firm is so successful, right? So that is deeply his idea and his thesis. I think every quant or trader who is successful just deeply cares about P&L. Like that's the only thing they care about. What I've seen a lot of very smart quants not do well is like they want to use some kind of model because it sounds cool, or like they want to do things in a certain way because it looks clean, or they think speeding up the training pipeline from 5 minutes to 4.5 minutes is going to improve their iteration speed, and therefore people, the guys who do well just work directly on making money, and there is so much money out there to be made if you know where you're looking that you can't afford to distract yourself. So that is, and particularly I have a metric that I have some friends who have a metric, let's say, they like to use, which is basically kind of money made divided by IQ, right? And I think the best quant, like you don't have to be that IMO gold medalist, but you can certainly do very, very well in trading if you are just very commercial and you're very astute and you know where to look. And that doesn't necessarily mean doing really advanced maths or whatever. It just involves understanding the game you're playing and playing it well.
Yeah, so you're saying like you don't have to be like 11 sigma smart. You just
Correct.
Maybe 4-3 sigma, and then more about like entrepreneurship essentially as well, blending like some rigor with practical
Yeah, and traders are very entrepreneurial. It's a simple fact. Like the way they're paid as well. It's like a percentage of their winnings, kind of like equity. And it's a reason why. I think we're going to see this more. And we can talk about this later. But it's a reason why historically, very few traders go and like leave their jobs and start jobs because they're already kind of doing an entrepreneurial venture. Like, you talked about the good traders, but I can tell you like any trader kind of. Even like a mediocre one doesn't really view their job as a job. Like they wake up and they check the P&L. It's like the first thing they do. All traders I know, if they have a strategy running overnight, the first thing they'll do as soon as they wake up in the morning is check how much money you made. So everyone views it as their kind of mini business. That's part of the beauty of the game.
Yeah. Okay, and there's so maybe just go as I wanted to. I also get there's another. I get some questions about this as well. Maybe we can start going to. Actually, no. Let's go into QFX. Let's go into that now because. So, how do you design the perfect market? So, like, what's the perfect market to you? Like.
So that's the important thing to you. I think there are different markets for different people, right? Yeah. And the design choices you make have to be aligned with what the users want, right? It's one of the fundamental paradigms of startups, like make something people want. That's YC's motto. The reason why traditional markets are broken right now is because those markets were made in accordance with regulation that was principally aimed at farmers in Midwest of the US, right? So the US has like the most liquid financial markets in the world. There's a very famous guy I know on Twitter called Flood. Very, 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 very smart guy, very astute guy. And he was like, Annanay, there's only two things that the US has really exported. It's culture and there's liquid financial markets. And he's right? Like I think that is kind of the crux of it. And if you look at the way markets are structured, and in particular, we're talking about leverage markets here, right? So we're not talking about stock market, we're talking about futures markets. I think futures markets have been designed with farmers in mind. And what do farmers care about? They don't necessarily care about making money, or they don't care about capital efficiency. They care about, I'm going to harvest this many bales of wheat at this point in time, and I want to deliver them to the Chicago Mercantile Exchange, and that's how many I'm going to do it. They can't deliver one more or one less, right? They're not really trying to like trade to make a profit, and that's how market structure has evolved. And now it's kind of being forced into this like square peg of like most people use markets for hedging or for speculation, or they want to trade futures because it's like capital efficient, right? To trade versus using. If you want to trade the S&P, you can go on Interactive Brokers. You can get 10 to 1 leverage on S&P futures on CME, right? If you want to do that through ETF, SPY, you don't get any leverage, right? Yeah. So I think crypto markets have realized that, and they've been catering to this kind of retail leverage trading crowd, and therefore they've made markets with optimal user experience for them in mind. What does that mean? It means running 24/7 so you can offer high leverages, right? Why does it allow you to do that? Well, if I'm your broker and I say, okay, you can have a load of leverage, but by the way, I'm closed for 2 days on the weekend, right? The market could close here and open here, and now if your liquidation price was here, I'm now on the hook for this much money, right? Yeah. So if markets aren't open 24/7, there's gapping risk. They're not going to give you a lot of leverage. If they're personally on the hook for your losses, they're not going to give you leverage. If they're connected to a clearinghouse, which is personally on the hook, if that broker goes bankrupt, the clearinghouse won't let them give you leverage. Yeah. Exchanges also making a lot of money on the fact that futures expire still, which doesn't really make any sense. I mean, okay, for farmers it makes sense, like I said, but the majority of market participants now are not farmers. Why does the S&P E-mini future, which trades $500 billion every single day, expire? I mean, it's probably going to trade way more today because it's volatile. Why does that expire the third Friday of every third month, right? Doesn't make any sense. The exchange is making money off it because people are having to trade continuously to stay in the position. So the perfect market is the market that people want to trade. If people want to buy and hold stocks, then they should look to the stock market. I don't think there are too many problems with the stock markets. I think markets for speculators and for kind of institutions who are looking to trade, maybe for non-speculative, maybe even for business reasons, but in a capital efficient way with leverage, those markets are broken. And I think a good market looks much closer for those types of people to hyperliquid. Right, I'm not saying Hyperliquid was perfect, but I think it's done the best job. And Jeff is a very smart guy, and he's thought a lot about these design choices. Much closer to Hyperliquid than it does to a futures market now, like in the US. And there are some extra design choices we have to make to list stock perps over the weekend while the underlying stocks are closed that Jeff didn't have to worry about with the first iteration of Hyperliquid. And I think once those are worked out, we will have something as close as possible to perfect for those kind of capital efficient leverage traders.
Yeah, maybe I've definitely actually gone into detail like what is a perp, and like you offering them on equities and FX, and this is like 24/7. That's like very disruptive. Maybe if you go into more detail on that.
Absolutely, it's a birth of a new market, right? So like this is going to be the first time that stocks are traded over the weekend. So what do we mean by that? Yeah, it's like perp is basically a future that doesn't expire. So what's a future? Let's start with that. A future is just a contract that pays the difference between the buy price and the sell price to the user, and it gets settled up once at the end of every day. So basically, if I buy S&P, if I buy S&P futures at 6,000, it goes up 6,100. Then I made $100 times the contract size of the future, which is whatever, I think it's 50 for S&P. So I made 100 times 50, $5,000, right? So a future basically is able to track the price of its underlier because of that settlement mechanism. So if the price of future deviates from the price the thing is meant to be tracking, then arbitrageurs can come in and trade the future versus the underlying in a way that guarantees them risk-free money. And that's why it always stays in line, okay?
Yeah.
So futures were really meant for farmers. Like I said, in the Midwest, they had crops basically that they wanted to give off. And at that time, instead of being financially settled, they were physically settled in crops. So if I'm a wheat farmer or I farm soybeans or whatever, if I have a future which is expiring in a month, I have to go and deliver those soybeans, and that I'll get them. And if the price of the future right now is deviating from the price of the soybeans in the stock market, then I can make a risk-free arbitrage. So the price of the future tracks the price of soybeans anyway. It gives me a good indication of what the soybeans are. Now, that mechanism of expiry, which is what causes the tracking to occur, you don't need expiry for that to happen. There are other ways you can make it happen mathematically. And we had Robert Schiller in 1993 put out a paper which described a better way, an academic paper, a better way to do this. And this was commercialized by the BitMEX team in kind of 2016, 2017, led by Arthur Hayes. They listed the first perpetual future. They just picked it up from academia, right, on Bitcoin. And it became a hit, right? It became a hit with everyone. And it became a hit with me because I didn't. When I was trading these things, I didn't have to roll them continuously.
Yeah, that's what the huge pain in the ass, the rolling.
Exactly.
Yeah.
So a perp is just a better version of a future. Futures have been around for hundreds of years. They were originally meant to help farmers. They now mostly just facilitate retail trading. Not retail, leverage trading, both retail and institutional. People realized that it was by mistake that they were facilitating leverage trading. They were never designed for it. And now we have perps, which is just a better design of a future.
Yeah,
so,
and for like a retail user, they're allowed to speculate, right? Quickly, they can predict like, okay, going down without actually owning the underlying asset as well.
Yeah, exactly. So that's a very important point you raised there. When I say leverage, leverage means buy more than the amount of dollars you have, but it also means short, right? If you want to go out and short Tesla, for example, in the open market, you have to find someone to borrow it off you. Often your broker will help you. But if there's no borrowers available, or if you want to short a stock where there's no one who's willing to lend you the stock in order to short it in the first place, you can't short it. Because shorting itself is a form of leverage. You're selling something you don't have. Yeah. Perps enable you to do that. So the only way to short, really, without paying fees in margining on traditional assets is through futures or their better version, which we're coming out with now, perps.
Yeah, and I guess as well the brokers, they charge fees as well, like expensive fees to be able to do that with perps. Like what I like about cryptos, like the perps, you can just easily just click a button or API call, create a short position without and that's it. There's no you just pay a take or make a fee, and that's it. Or funding as well. But yeah, anyway, that's another interesting we can talk about is funding. But yeah, maybe you talk about the the weekend effect essentially, maybe because for example, let's say Google, I don't know, maybe Google, okay, say Amazon, okay, let's say they have a data outage at the weekend, and it'll be quite interesting to see, you'll be able to speculate on that essentially, okay, this outage, how long is it going to be? Maybe you have a discretionary opinion that the market go down, you'll be able to do that with QFX, right? You're just like, okay,
absolutely. I will caveat that saying we run on AWS, our servers, so we run in multiple regions. So
okay, yeah.
as long as all of Amazon like entirety in the world doesn't go down, you will be able to. Yes, because we have failover.
I think I read something on Weiss, Hacker News, that that outage, it showed that there's a weakness in the fault tolerance, because they're all like saying it's fault tolerance, we're multi-regional, but that happened in just in one area, and it affected like multiple regions.
Yeah, not as many people are as failover friendly as you might think. It's hard, right, to do like fully automated failover. I think a lot of SaaS companies, particularly, their product goes down for a few hours doesn't really make a difference. But for us, we want to be legit and solid. I mean, with Cloudflare, a lot of people are dependent on Cloudflare. A lot of crypto exchanges went down as well because they rely on it for anti-denial of service blocking. It went down. Yeah,
and you mentioned about anti-latency arbitrage. Like that's a very important to you, right?
Yeah, sure. So this is, I mean, if anyone wants to read more about this, I advise them to read Alex Gerko's papers. He is definitely the best markets thinker of our generation. He's thought very, very deeply about a lot of different market structure choices. And his firm XTX, as well as being a very successful trading firm, does publish papers outlining how they think about markets and what they think the fairest outcome of markets is. Alex has made so much money. Like, I don't think he has any he's not trying to like run his own book, right? He's not trying to push the market into a way that would benefit XTX. I think he generally just wants efficient, fair markets, kind of like we do.
Yeah.
Anti-latency arbitrage is basically, so what is latency arbitrage? Firstly, it's basically if you have two exchanges both offering the same or very similar products, and it moves on one exchange, usually the more liquid exchange, because that's where moves originate from, because the biggest traders tend to trade there to lower their transaction costs. What happens is high frequency trading firms basically pick up that signal and move it to the other exchange as fast as possible, and then try and if the price hasn't moved up, let's say moved up on the main exchange, hasn't moved up on the second exchange, they basically try and buy on that second exchange, and then all the other market makers on there will be like, oh, well, price went up, and now we've done a trade at a bad price, right? Because we just sold it at the price and then it went up. So this is a problem for new exchanges. We're a new exchange, so it's going to be a problem for us. Yeah. It won't be a problem during the weekends because nothing else is open, but it will be a problem during the weekdays because, it's basically we are ultimately listing futures that track prices on major markets like New York Stock Exchange, NASDAQ, Chicago Mercantile Exchange. And in the early days, we want to make sure that people can trade on fair terms and they're not worried that if a fast high-frequency trading firm with like very, very good infrastructure comes in, that they will start arbitraging them. And therefore, what we've done is any arbitrage order basically has to cross the market. And basically, it means if you can sell here and buy here immediately, any order that comes in which would trade immediately, we just buffer it for 50 milliseconds before it reaches the matching engine. So you can still cancel. You can place orders that don't cross the market, but you can't cross the market without waiting 50 milliseconds first. And that's very fair because if you're a slower trading firm or retail, right, you don't pay any penalty because generally you can't react to those time frames anyway. And if you're a very fast, very predatory firm with like a lot of latency edge, then that's the only time that you like really lose out. So it affects them very disproportionately, and that's why we've done it.
Yeah, that's really good. And about fees as well, like transparent fees.
Yeah, perfectly transparent fees. I think Crypto World does a very good job making their fees as transparent as possible. We want to avoid that. The CFD world, if you're kind of familiar with CFDs in the UK, they're very intransparent. They go advertise zero spread, zero fees, and then you open a trader on a US stock, and it's like, well, okay, I just paid 70 basis points, 0.7% to do an FX conversion, right, in order to buy the stock. So we don't do any of that. It's all as transparent as possible. We do charge fees. They're very low while we're trying to grow the exchange. I would say be wary of any exchange that doesn't charge fees because they are monetizing in a different way, in a more sinister way, which is basically selling your order flow in a preferential way to certain market makers. And there's a lot of back dealing going on because the exchange is going to
like Robin Hood, right?
Yeah, like Robinhood, exactly. So we avoid all of that. We don't do any like internal deals like that, and we just have transparent fees because that is, ultimately market making is a service. You have to pay people for it because it's a difficult job to do to kind of quote prices on things and manage risk. Somebody has to make money, right? So they either make money transparently, which is we get paid fees and they get paid in spread, or the money is made intransparently and no one knows what the actual costs of their trading are, which is people think they're trading on zero fees, but actually their order is getting filled by someone at an uncompetitive price and we're taking a cut of that. Like we don't touch that. We're pro transparent fair markets, and that's a design choice we made from day one. Same as Hyperliquid, they also charge fees and they don't have any special market making deals.
And we'll be having like discounts based on the trading volume as well. Like if you're trading more.
Yeah. We will have a discount based on trading volume. People pay trading fees in proportion to kind of their activity on the exchange.
Yeah, I think I remember. How do you handle the balance between model complexity and execution latency? Do you favor lightweight interpretable models or heavier, more predictive ones?
Yes, so a lot of things wrong with that question, so let's unpack them. Heavier does not necessarily mean more predictive, and the trade-off is not just between simplicity versus latency. What this question is referring to with lightweight models is fundamentally there's thing in models which is just how many free parameters they have. And if for people who aren't mathematical, I'll just kind of say it in simple terms as possible. So say I have a single variable, right, and it has some has some response to some system out there, right? So let's make it in trading terms to make it as simple as possible. We have a variable which is like order book imbalance, and I want to use it to predict the return of a stock 5 seconds in the future.
Yeah.
Right. So difference between the stock's price later and the stock's price now. Right. Simple. I could basically do I could collect a bunch of these data points, right? And I could have like 20 data points, and I could put them on a graph, right? So on the x-axis, I put the value of this variable, the order book imbalance. Let's say bid quantity divided by ask quantity. On the y-axis, I could put the response, which is basically the price return in 5 seconds. And I can fit a straight line through them. Now that straight line, there's two things I can specify for that straight line. There's the slope and the intercept. So there's two parameters, right? I could decide, actually, this model doesn't fit the data well enough. I want to put a parabola through it, so a quadratic equation. Now I have three parameters. Y equals ax squared plus bx plus c. Three parameters.
Yep.
I could go 4 cubic, I could go 5 quintic, okay? It doesn't have to be polynomial, right? I could put a plus z times log x in there, right? It's like another one. So all of those numbers I can now tune to get this line fit through this data as nicely as possible are called parameters. And a common thing in modeling is like, how many parameters do I give my model? Basically, how squiggly a line do I fit through my feature, with my alpha, the order book imbalance, and what I'm ultimately trying to measure. The trade-off with simpler models is like, the trade-off is basically, there's two things. One is in terms of how long it takes to compute them, it's much quicker to compute models with a lower number of parameters, right? That's one thing. Yeah. And the second thing is that it is much less likely to overfit in a model with a fewer number of parameters. So what I mean by that is, so you had a straight line and all the points ran exactly on a straight line, right? And then you have 100 points and they literally fit a straight line perfectly. And you take one of these points and you just move it slightly, you move it off the straight line. Now, if somebody looks at it, they'll probably be like, well, I mean, that's obviously just like a slight measurement error. This is just a straight line relationship, right? It's like dead simple. You just fit a straight line through the middle of this. If my model has too many parameters, though, it could make a squiggle that goes through every point, dips down, hits that point, and then goes up. So this model, right, has now effectively overfit this data. It should have been a straight line response, but you've actually said, oh no, the real complexity of the world is that this point does deserve to rise slightly off the straight line, where it doesn't. So when you have lots of different alphas that you're trying to combine and lots of different data points, it's very easy. It's very hard to visualize whether you're doing anything wrong. So you have to just rely on the numbers to do a good job. And it's very easy to start fitting squiggles everywhere. because your data is just slightly off, right? It's all, you're measuring noisy data ultimately. It's very low signal in the data. So that's the biggest trade-off, because actually in terms of latency, you can basically pre-compute models. That's very common. So, rather than kind of waiting for the market data update to come and then computing my model and then being worried that my model is too many parameters, too slow to compute, you can what a lot of trading firms do now is like they'll just like get a bunch of data, and then they'll say, okay, like maybe the market will go up this much in each of these scenarios. What would the output of the model be? And then they'll just kind of put all of those in a like a lookup table, and then when the market data comes in, they'll be like, oh, it was this scenario, so we'll do that. So latency is not really that much of an issue. It's more like model complexity and fitting. Yeah.
So your personal preference, let's say you're on the island, okay, would you prefer to use a neural network or would you prefer linear regression?
It's so if you use a neural network very well, it will have slightly better performance than the next lower tier down and the next lower tier down, all the way down to linear models, which are like the simplest models, I guess.
Yeah.
However, it's also just like much easier to mess it up. Like if you only have a short amount of time and you're not very sophisticated, you're way less likely to mess it up with a linear model and therefore get a better outcome than you are with a more complex model.
Yeah.
Simplicity is always better.
Yeah, I think that's very, very important. Yeah, it's like driving a Ferrari. Like if you've never driven a Ferrari before, you can easily crash. Okay, so do you? This is interesting because you were going to do a PhD in quantum computing. Do you see emerging tech like quantum computing or specialized hardware changing the speed intelligent balance in HFT?
Not really. I think quantum computing is very far away from being able to produce anything particularly useful. I'll address it very quickly. I think so. Speed is very, very, very overdone in trading now. Very few trading firms try and kind of optimize speed. I think it's a very old way of trading because that trade is basically very saturated now. And it only works for very short time horizon type signals, right? If you have a predictive alpha which tells you where the price of something is going to be 3 years down the line, you don't need to lock the last microsecond off your execution latency, right?
Yeah.
And what a lot of HFT firms are learning now is like these very short time horizon alphas, because they just kind of get in a trade, get out of a trade, get in a trade, get out of a trade. They're not actually able to like build up a big position and make a lot of money. They have very high Sharpe, but the actual amount of money they're able to make overall is not that high. So that side of things is pretty much dying. I'll make a comment on the quantum stuff. Quantum stuff is the way all. There's a great theorem about this, by the way, that we learned when I was at Cambridge in my third year. So basically, the basis of all supremacy that quantum algorithms over classical ones is that they're able to harness a property of the physical world called entanglement. Right, so entanglement basically means if you have two quantum systems, they're always kind of coupled to each other, whether you like it or not. And if you prepare the state of these two systems together in a certain way, by measuring the state of one, you can guarantee and kind of change the state of the other. It's like a very, very like high level. You have to use very careful language to describe what it is. That's like a high level way of looking at it. The way all quantum computers improve on classical computers is they take advantage of this property. So Shor's algorithm, which breaks RSA encryption, basically does it by setting up the maths problem that you need to do to break RSA algorithms into a system of qubits, and then it does a de-entanglement operation basically that does like effectively very, very, very parallel computation. So you can think of entanglement as like doing computation on lots of things in parallel, and that's how it breaks encryption. So people haven't really found how that is going to help trading, to be honest. There's like papers on quantum machine learning. So maybe we'll do machine learning faster. I don't think it'll be like that big step change like it's going to bring to cryptography, for example.
So you don't think you'll like go into where, like, for example, you're not having NVIDIA GPUs, you may be having, I don't know, like a quantum-based card to do the training on? You think
like I said, you have to look at what these things are actually doing, right? Like a lot of people don't understand the actual nuts and bolts of what a quantum computer is, right? Like it is basically just a noisy classical computer with this one extra aspect of physics that it exploits. Until somebody makes like a decent algorithm which can solve a task in machine learning, which is basically what trading is all about. It's just like doing statistics, basically statistics and machine learning, that cannot be solved efficiently by classical computers. It's just very hard to see. There's no computation we do in machine learning that is like NP hard, really, right? It's all just like number crunching and like, yeah, maybe they'll speed up number crunching a bit, but like it's not. It wouldn't be worth the effort to use a quantum computer like that. No.
Okay, all right, that's good.
Right, like quantum computers are good if you have like some like exponential time problem, they'll turn it into a polynomial time problem. Like, but there are no exponential time problems that we routinely used. Somebody would have to make like some amazing machine learning algorithm, but the only way it's not used the only reason it's not used in the real world is because it involves solving some NP hard problem somewhere, and somebody would have to make a quantum algorithm to solve this NP hard problem in a class in like polynomial time.
Oh yeah.
But there are just no algorithms like that, and there are no problems like that, and there are no statistical techniques like that. So
yeah, so it's hard
maybe
to
nothing on the horizon. Yeah.
It's okay. It's an interesting one. So what mathematical concepts or areas give you the highest leverage when building strategies and creating an edge?
Probably none. I mean, like nothing I learned at Cambridge for sure. I'm sure there's like, if you take like a course on machine learning and just like, anything particularly practical or applied, I think you can learn at university that kind of helps you think statistically and isn't just like, at Cambridge the course was very theoretical. The professors were like, our job is to turn you into field medalists and not traders. It's like, that's why I became a trader. I couldn't become a field medalist. So that's
but in the shoulder of giants, right? With the Cambridge Tripos, there's like very famous people. And also have to think very quickly, I guess, as well, because these exams very, demanding questions very quickly. You need to on the spot.
Yeah, for sure. Cambridge was more an education in. I mean, the number one benefit of going to Cambridge was the people you meet, and then number two is like the intellectual rigor and kind of having to think very carefully, and number three is like the discipline it forces you to have. You're like, okay, I'm a university student, so I want to somewhat enjoy my life, but I also have to pass this extremely hard degree.
You have to balance the two, yeah.
Yeah, so I have to, I have to decide what I want and then work towards that, right? So it's like there's very little time for lying around in bed and checking your phone. I still don't do that. I mean, until I started this company, I had no social media still because I just thought it was mostly a waste of time. Now I don't agree with that. I think there's a lot of good content if you're in the right kind of circles and stuff, and it's a good way for people to share thoughts, and you can use it to your effect, to your advantage.
Yeah.
But that was most what I got out of my degree. It wasn't specific things I learned. I think if you go and do, there's a lot of these courses out there where people, they kind of hint that, you can get a job in trading or in finance. I think it's unlikely to learn anything you would directly use kind of on a day-to-day job. It's more about kind of the prestige of the course. I think that's
so you wouldn't do like one of these really expensive quantitative finance courses?
I would not. Yeah, I think they're just a cash cow for the universities, to be honest. The people who are getting the trading jobs don't need to do those courses. So if you were doing the course, like why.
Okay, let's just pause it. If you had to, let's say I put a gun to your head and said, okay, you have to do some retail trading, would you go through, let's say, a broker, or would you prefer like a direct market access, like a crypto exchange?
Depends what you want to trade. All crypto exchanges are direct market access. All traditional exchanges are broker intermediated, except for QFEX. So if you want to do brokerless trading on traditional assets, you have to come to QFEX. We're the first one, the only one.
Yeah, I think that's a very, very good point. Okay, so now the next question. Okay, this is a good question. So how would you manage tail events that you can't backtest? Maybe just explain what a tail event is.
So tail event is just some absurd event that no one, also called black swan events. I don't know. The US stock market crashes 60% and then recovers immediately, like 2 tail events in a row, right? How do you manage them? Can't backtest them? Yeah, indeed, you can't backtest them. So that's the difficulty, and that's why you have risk limits, right? So we do backtesting to test strategy performance. We have risk limits to prevent worst case losses. There was a great video I watched of Seb Barak, who's the head of commodities at Citadel, and they have to think about tail risks all the time because they're trading all these like physical commodities moving between all these unstable countries. And he said basically they have two layers of it, right? They have a capped losses and then uncapped losses. So every time they do a trade, they think, what is the worst thing that can happen to me on this trade, right? And if it's capped, they're like, we just have to say, okay, if things go really bad, this is how much money we're going to lose. We have to make sure it doesn't bankrupt the firm. Okay, and he was like, the reason Citadel Commodities is a very tough game because almost every good commodities trading shop at some point blows up because they don't have these tail risk controls, because tail risks happen surprisingly often in commodities because wars just happen, right? Like you're trading oil between Germany and Russia, which is getting all this like cheap Russian gas and oil because they don't really like to talk about it. And then Russia happens, they're like, oh okay, Russia Ukraine, like okay, we really can't take this anymore. That's a huge supply shock, right? Huge supply shock. So that will change prices very quickly, and a lot of people will have got wiped out. So what's important there with tail risks is, cap losses. How much could it lose? Will it bankrupt the firm? Okay, you have to be comfortable, not comfortable, but you have to be like, okay, I need to make sure that this is not catastrophic. And then uncapped losses, I think what he said was we have to be able to exit the position within like a certain time frame, basically. So anytime in high frequency, it's actually very easy because our strategies are so high sharp that even if you have one down day, that's a bit unusual. So if you lose a lot of money very quickly, just turn your strategy off because something has gone wrong. And if you have a few down days in a row, probably turn your strategy off as well because that's also not meant to happen.
Yeah, sorry.
I think that the harder thing is like when you're in less liquid markets or you have some low sharp strategy and you're like, hey, the strategy lost half of the capital that was allocated to it overnight. Is that meant to happen? Like, or is it just like a low sharp strategy and tomorrow it will gain it all back? And I've seen $1 billion a year strategies that have a sharp of 1, but over the course of a year, they generally still make a lot of money. You want to turn them off. Like that strategy like that can lose $100 million in a day, and it's not a tail risk because it's a low sharp strategy, and it's been designed like that, and people are comfortable with that risk. So it's about knowing what it's meant to do, and if it deviates from that, when to turn it off, and also knowing what the worst amount of money you can lose is. Those things are very important.
So maybe we'll just go into that. How would you manage like a model drift? Like, so when do you retrain and when? So
that's a little different to tail risks, I guess. Model drift, just to kind of give like some context, is like you have you have some model that's been trained on some data and it's learned that data, that state of the market, right? And then things change in the world and the way the market reacts to all the things that the model is trained on have now changed. So it no longer is a very good model. What I will say is that in generally in trading firms, so the way you get around this, you do something called like normalizing the features, which is basically saying
standard scalars and stuff like
that. Doing standard. So basically, I'll give a very simple example, right? You could have a price move. So let's say I have a feature which measures a price move over 5 seconds in a stock, right? So I have a $100 stock and it moved to $101, a 1% price move. Now, do I encode that in my model as a $1 move or as a 1% move? Right? And basically, you should encode it as a 1% move because when you do your training over like a long period of time, right, what will happen is that at some point the stock will go to $200, right? And when it's at $200, you know intuitively that a $1 move doesn't mean as much in terms of economic significance as a 1% move, which is a $2 move, right? Yeah. So this is a very simple example of normalization, but you try and create model features that basically are agnostic to the market conditions as much as they can be, and you try and train them over a long period of time so that they're able to pick up a lot of different types of market conditions, and they don't have to extrapolate as much when they actually try and predict your market live. So when you do that, model drift should be very slow, and we never had like a scheme to worry about model drift because like we would generally update and improve our models faster than they would turn unprofitable.
So you'd always recalibrate weights at a specific time period?
We weren't even recalibrating. We would just like figure out like, oh, this is a better way of doing this. So let's just like make a new model and just replace the old one.
So you always like iterating, improving the.
The improvements were so much faster than the model decayed that we never even bothered figuring out like what do we do when it decays. Yeah.
Gotcha. Okay. All right. Yeah. Okay. So what does the internal decision process look like for moving a model from research to live trading? I'm curious about the mathematical or statistical validation steps that can make you confident that the edge will hold in production. That's a good question.
Yes, so production is the gold standard, right? So the gold standard is always just start in small sizes in production. There's nothing really better than that. I think there's like a lot of things you can do. I'll give like high level overview, but basically, first you make sure that your signal doesn't actually is not overfit. And the way you do that is, you have some predictive signal. You don't train it on all the backtest data that you have. You train it on some of it, and then on the remaining bit of data, you just try and figure out whether it actually did a good job at predicting on that remaining bit of data, right?
Yeah,
so
like
that's called an outer sample. Yeah, it's called outer sample score, basically. Like what's the mean square on the outer sample? So that's step one. Like make sure your model isn't overfit and make sure it actually does price prediction, and then you need to see like, okay, my model has predictive power. Will it make money? It's the most important thing. Will it make money?
Yeah.
For that, you do some kind of back test. You can get really sophisticated back test. At Tower, we had a very sophisticated back tester.
Yeah.
You can start coding something in Python.
So you didn't really care too much about, like, say, R squared coefficient then?
Yeah. So that's what I meant. Like you measure the outer sample R squared.
Yeah. But would that help you with profitability, right? Does that correlate to profitability?
Yeah, not really even that much, to be honest. Like, because R squared just measures like what you predict the future return. But the problem is, what you really need to measure is like how uncorrelated your model is to everyone else's model. Especially given the data and given that other people will be recalibrating their model on this data. So that's I mean, like you use R squared to in the trading process itself, right? And you make sure that the trained R squared doesn't like you make sure it kind of plateaus, and then you just kind of like take the test R squared, right? And then you use that to kind of have a good idea of how good your model is. Like maybe you have different models with different test R squareds, and use that to tune hyperparameters of your models and stuff like that. But model R squared, like outer sample R squared, like as long as it's somewhat reasonable, it doesn't really tell you how profitable the strategy is. It can tell you if a strategy is going to be unprofitable if it's zero. You could have a very nice R squared strategy and then like doesn't do well. And then there's also like, you can't compare two models based on R squared, because what if one's predicting 5 seconds ahead? What if one's predicting 5 minutes ahead? 5 minute ahead model is going to have much worse R squared just because it's harder to predict 5 minutes ahead, but it could be way more profitable. So it could be capturing variance that other people are not capturing.
Yeah. Okay. Now the next question is what's a big company's trading firm's approach to developing an edge, or do these companies just copy one another?
They mostly copy one another. That's why I try and poach from other firms. That's why non-competes are super long. And a lot of the top firms as well. Truth be told, like it's very competitive now. Like we're really in like the nitty gritty of like tiny model optimizations can just put you one step ahead of your competition and make money. I think like the biggest thing we've seen is firms trying to do different things in terms of time horizon. So some firms will try and trade on the 30-minute time horizon. Some will trade on the 1 minute time horizon. And then people are playing different games and not directly competing with each other. But yeah, I mean, honestly, like there's not too many truly differentiated ideas that I've seen out there. It's more now. It's like the sum total of kind of HFT alpha is kind of there, and it's just like implementing it and making it perfect and running experiments and stuff like this. And the firms have done really well, to be honest, recently in the last 3-4 years. Hudson River, it's not come out of nowhere, but it's done really well in the last 4 years. They're just the ones who made this kind of really detailed model building a machine. They've like pipelined it. Citadel Securities has done the same thing. They've got it like down to a T, and they don't miss anything. Basically, there's no room for errors. So that's a testament to their management. I think there's this like myth of like the genius Soda Quant, but Citadel is a phenomenal management. So does HRT. These guys yeah, like they structure the research and the pipeline. They use their talent in the best possible way. So unfortunately, it's just like any other business. There's no simple answers. Yeah.
Yeah, no worries. Do you think markets are ultimately predictable in a probabilistic sense, or are they fundamentally chaotic and driven by human reflexivity?
No, of course they're predictable. It's like
Otherwise,
it's a huge industry, assuming that they're predictable and they consistently make. I mean, HFT probably like a 70-80 billion dollar year industry now. It's like fairly consistently growing.
Yeah. Okay, so the next one is is any reinforcement learning used in HFT?
Yep.
Yeah. So the next one. What kind of advantage do these current companies have in terms of order execution?
Yeah, very good question. We haven't talked much about order execution. It's very important to kind of flesh it out a little bit more. There's basically two things you need to do to make money in trading, right? One is predict where the price is going, and the other is execute orders, like monetize it, basically. It's like, if the price is going up, what do? Do I place a buy order? Do I immediately cross the market? Do I put it in the middle of the book and hope somebody else will trade against me? How much size do I do? What if I'm already really long? Do I want to get more long? If I'm short, do I want to like be really aggressive and try and get out of the short? All these questions, right?
Yeah.
Order execution is a lot about kind of latency and placing your orders very quickly, especially if you have not particularly good alpha. What kind of advantages these firms have? Yeah, they have like very good engineers. They have very low latency C++ code. They often place their servers that process these orders very close to the exchange, so there's less physical distance to travel to go hit these orders into the market. That's basically, I would say, some of it. Is they have speed edge, and there's lots of like little niche things, like different exchanges have different API endpoints, different gateways, basically, that you can send your orders through, and they'll figure out which is like the fastest one or something, things like that as well.
Yeah. Okay, here's a good question. Okay, so for example, one of the viewers, he's like a PhD in maths, and he's like wondering like, the application of, let's say, certain fields like functional analysis, algebra, optimization theory, probability theory, like...
None. Zero.
Yeah.
None. Probability, especially at the PhD level, you're just talking like measure theory, right? So like, Lebesgue versus Riemannian integrals are way more advanced than that. None. Yeah. Enjoy your time, learn your maths, and then if academia isn't for you, feel free to join us on the dark side, but you won't use anything you've learned. Sure.
Okay. All right. That's an interesting insight. So, is there a case rate for new hires? Is there a case for the rate of new hires in MFT and HFT continue to dwindle? I submitted over 1,000 applications to trading firms with prior experience, and very hard to get an interview.
I think it's dwindling. I think they're hiring more, to be honest. I would advise you to use a headhunter. So these kind of online careers apply here things. No one really reads those. If you have kind of prior experience, go find a headhunter who basically knows what roles they're really hiring for. They get retained basically on mandates to go search for a particular role by various companies, and if you're a good fit, they'll submit your CV and then see what you can do.
Yeah, and the advantage of recruiters is that they can go straight, send it directly to the hiring manager, right?
Yeah, exactly. So they have a relationship with the hiring manager. I mean, I believe almost I don't actually know of any experienced hiring that's happened not through a headhunter, to be honest, in HFT. So you have to go find one of these groups. Options Group, they're a good one. You can go.
Options Group, yeah. Okay. I think we're sort of... Okay, here's an interesting question. Is the threat of AI replacing workers real in, say, 7 to 10 years time span?
Absolutely, yeah. Totally agree with that.
Yeah.
I mean, it's already getting good at very, very, very many things. I think we would probably need another 10 engineers to build what we build here in terms of code gen and so on.
Yeah. Okay. And here's what are the top 2-3 things HFT firms look for in candidates?
Depends on what level. Experienced hiring, they're just looking at what you've done before, and they're looking to see what alpha that they can add to your firm. For grads, all those things I mentioned before, kind of evidence of just generally being a smart person and being quick-witted. Then different firms look at different things. Some like the kind of poker player stereotype, some don't.
Yeah. And in terms of interviewing, how much should you reveal? Like in terms of your alpha, like.
Yeah, you should. It's a very, very tough question because you want to get a job, but you also don't want to seem like you know, when you go off and leave that firm that you're going to spill all their secrets everywhere else. I would say be careful, right? Like operate within the law. You do have implied and express responsibilities to your previous employer. Like often they have like non-compete agreements and so on. So don't say anything that could land you in court. But it's decision for everyone to make themselves.
Yeah. Okay, so here's a good question. What are the most modern software frameworks and languages used nowadays in the industry? And what other frameworks are obsolete yet still used?
Most of the industry runs on C++. For the trading stack, and then Python, Pandas for data analysis.
Yeah. Okay.
People used to use Java for the trading, but no one does that anymore.
Yeah. What about this is the last question. Okay, so do you use the limit order book or just use like open, high, low, close bars?
We use limit order books.
Yeah. Okay, I think that's everything really.
Amazing.
And thanks so much. A lot of pieces of gold there extracted.
I thought some new things as well. We'll probably put on Twitter at some point. It's very very good. I love doing these things. It's answering other people's questions. You think of new things yourself, which is always very fun.
Yeah. Okay, so that's it. And enjoy your weekend and in touch.
Yeah.
Okay.
Cheers. Thank you. Enjoy your weekend. Bye.
Key takeaway 1. Annanay is taking the innovations in the crypto space and making it mainstream by allowing you to trade stocks and FX 24/7. Key takeaway 2. Be careful of zero-fee platforms and brokers. As Annanay says, be very cautious because there are hidden fees that are not transparent and you're typically worse off. Brokers with zero fees will charge egregious spreads that evaporates any edge. Also, there are trading apps that participate in payment for order flow, which is essentially the app selling your order to a market maker that are not incentivized to give you the best execution price. I have a link to Alex Gerko's post for a good explanation why it's bad. Key takeaway 3. QFEX will be a very efficient way to trade stocks and FX because it's brokerless and gives you direct market access. The fees are transparent and the order book is not paywalled, so it gives everyone an equal playing field. Having free access to the order book gives you a huge advantage. Key takeaway 4. Simplicity over complexity. Annanay talks about parameters with respect to polynomial curve fitting and how increasing the number of parameters increases the risk of overfitting to noise and not generalizing, so he prefers models with less parameters. He would prefer to use a simple univariate linear regression over a 1 million parameter neural network. On this channel, I preach linear regression and logistic classification, so hopefully Annanay convinces you to decrease your model complexity. Key takeaway 5. Annanay talks about the key characteristics of the most successful quants that he has worked with, and he says the most successful ones were all extremely motivated, entrepreneurial, and pragmatic. You don't have to be in the top 0.1% of intelligence to be successful. Annanay mentions if he had to trade independently on a desert island, he would run market-making algorithms on a smaller, less efficient market and be compensated for making it more efficient. The analogy is that it's better to be a big fish in a smaller, less crowded pond than a small fish in a big, overcrowded pond. There's lots of markets that big firms cannot legally trade in, nor big enough trading volume to justify investing time or resources to trade on. Key takeaway 7. Annanay recommends to find a good recruiter. By using a recruiter, they will put your CV directly to a hiring manager and guide you through the interview process. Key takeaway 8. Annanay talks about how academic papers on market making are useless and no one uses them. Unfortunately, there isn't any good literature on market making. I do, however, have a video called Introduction to Quantitative Trading where I explain market making and axiomatically break it down into two key mechanics, spread and bias. I've provided a link to the video in the description below. Key takeaway 9. Annanay recommends to avoid expensive university quant finance courses, the cash cows with little real value. Instead, pursue a STEM degree instead of studying finance. Finance concepts are straightforward and learnable on the job. However, scientific and technical skills from STEM programs are much harder to acquire later. Bottom line, STEM degrees provide far better preparation for quant trading careers than dedicated quant finance courses, and much cheaper.